Back, great to have you with us on SABC's News at 1, and it's not looking good for our rand. But first, let's look at the global picture on markets. Asian shares ended mixed today as the euro stretched gains ahead of a European Central Bank meeting that could result in a less accommodative monetary policy. Also influencing the markets, Wall Street pulling back from record highs. So in Asia, the Japanese Nikkei share edged up, lifted by shares backed by strong earnings. But embattled Kobe Steel fell after saying it lost an industrial certification for copper products. The Nikkei ending 0.5% down. Hong Kong stocks softened after Wall Street pulled back from record highs amid concerns of tighter liquidity in global financial markets ahead of that ECB meeting. The Hang Seng Index lost nearly 0.5% in Shanghai. Stellar earnings from companies such as liquor maker Montao and expectations that Beijing will push forward Belt and road projects move the markets up. The Shanghai Composite Index adding 0.33%. Okay, so after the incredible run we've seen of late, it's all changed. US stocks slumped yesterday with the Dow Jones Industrial Average and the S&P 500 suffering their worst day in 7 weeks due to a batch of soft quarterly earnings and a rise in bond yields. The benchmark US 0-year note yield hit a 7-month high. Shares were also buoyed by economic data, recent optimism over progress on tax reform by US President Donald Trump's administration, as well as anticipation of a nominee to head the Fed Reserve. But those tax cuts, everything was helping the markets. Now they're down. The Dow fell by 0.4%, the S&P as well. The Nasdaq Composite Index dropping by 0.5%. All right, a day of after the midterm budget speech, the rand is down, but the market continues to go up. Let's see what's happening overall with Nompu Siziba live at the JSE.
Thanks very much, Francis. Well, as you do mention, the rand not doing well at all. It's now hovering around 14.23 against the US dollar and around 18.82 against the British pound. Not doing very well at all. It's continued to lose following that statement by Finance Minister Malusi Gigaba yesterday, telling us that the economy is really not in the greatest shape, that it anticipates that growth will slow down to 0.7% this year. The budget deficit is expected to hit 4.3% of GDP, whereas the earlier expectation had been 3%. This is huge, especially because it's in terms of the overall GDP number. These metrics sent a real chill down the market spine, and we've seen a very adverse reaction there too. Our bond yields have risen, and that just simply means that people who want to invest in South African bonds demand a higher interest rate because they feel that this is now a riskier place to invest in. So if you are lent money via the bond system, then you have to pay a higher interest rate. Generally speaking, obviously, the midterm budget was not well received, and it has really bad consequences for the South African economy. But I think the big question mark now is, what does this mean for our ratings agency, for the ratings agency's decisions come later November and early December? What will they say about our credit rating? Are we going to be further taken down into junk status, which again will see more of a sell-off on the rand? A sell-off on the rand is negative because we'll get higher inflation, and no doubt Mr. Hanyako will have no choice but to raise rates, which will put us all in quite a pickle. Let's take a look at the indicators. I'm joined by Chris Gilmore. He's an independent analyst. Thanks for joining us, sir, as always.
Good to be here, Nompu.
Before we get into the local fundamentals and issues, just give us an analysis of what's happening on global markets and the key drivers.
Yeah, last night in the States, as the preamble was saying, we saw the first, the worst decline in about 7 weeks. Asian markets opened a bit mixed this morning. We're slightly up today, but I think that's really because of the fact that the rand hedges are doing well because the rand is so weak. So one shouldn't get too surprised about that. And if the rand's going to remain weak, as I suspect it will, then I think the rand hedges, some of the gold mining companies will actually start doing quite well.
And we are seeing those mining counters doing quite nicely. They were up by as much as 2.5% earlier this session.
Yeah. So basically what you're looking at is a situation where, because of the weak rand, their costs are in rands. They're selling in dollars for most of their output. So as far as they're concerned, this is actually very good news. No, it's not so much for the big multinational conglomerates, because South Africa, for them, is actually, in most instances, is a relatively small part. But for the single commodity stocks, the gold miners and things like that, it's actually good news.
Now, yesterday, Mr. Gigaba delivered that tough speech, which ultimately was not positive about the economy. And today we're seeing the rand really just faltering beyond belief. What does it all mean, and do you think it's going to be sustained?
When you say, do I think it's going to be sustained, it's what going to be sustained?
The weakness.
Yes. Look, I've been saying for quite some time that the likelihood is we're going to get a further ratings downgrade. But that's going to be a serious one. The one we had a few months ago was on our foreign currency rating. And the next one will be on our local currency. And that is far more serious because that's where about 90% of our debt is located. And over and above that, about 40 to 50% of that debt is held by foreigners. So you get a nice, well, not a nice, but it's a horrible double whammy coming through. So basically what will happen, I think, is that this will be seen in a very negative light. As I drove in here on the radio, it said that Malusi Gigaba, the finance minister, had phoned all of the ratings agencies this morning to look for their feedback. And in all instances, they were shocked. I think they were shocked by a number of things, not the least being that we saw the budget deficit, which you mentioned, going to 4.3%. Nobody was looking for figures like that. Debt to GDP going to 60% over the course of the next 3 or 4 years. One thing that a lot of people don't realize is that debt figure of 60% does not include state-owned enterprise debt. So Eskom, Transnet and SAA might be quite small in the overall scheme of things, but it's all grist to the mill. Add that into the equation, you're probably looking at, if nothing else happens, a government debt to equity in 3 or 4 years' time of 75%. For a developing economy, that's not where you want to be. So this is extremely bad news, and I think it will be seen as such by the ratings agencies. So that's why I think that the likelihood is it probably brings forward the time horizon that they will give us this downgrade. I think the consensus out there is that the ratings agencies, S&P and Moody's, I think, are meeting on the 24th of November. Fitch doesn't give actual dates as such. And most people were of the view that we'll probably wait until the elective conference, the ANC's elective conference in December, and the national budget in February. After this shock and horror, shock and awe, I suspect that that time horizon will now be brought forward.
Now, my next question. You've answered a lot of questions in your one answer. But that's not a problem at all. Now, assuming that the downgrades do take place, and we get into that terrible situation that Brazil and Russia, for example, have experienced, what are the solutions? Because one of the concerns among market analysts is that the minister didn't really seem to proffer any solutions.
Yes, there was no plan at all, nothing. And it reminded me a lot, as we were saying before we went on, of Jacob Moroga, who took over the Eskom chair, the CEO position in 2007. And he alerted the country to the dire state of the utility, undoubtedly. And in that sense, he did a good job. But however, there was no plan. And a few months later, it's all history. We were in the depths of the Eskom crisis. Now, same way, Malusi Gigaba has offered no plan whatsoever. His predecessors, Pravin Gordhan and more importantly, Nhlanhla Nene, if you go back a couple of years ago, Nene actually made it quite clear that you have to start reducing the deficit. And if that means making tough choices and tough decisions, so be it. And I think that's probably why he was fired, because he was prepared to do it. He's a man of great integrity, as was Pravin. So unfortunately, now we don't have the same kind of thing coming through. We're going to be perceived, I fear, as letting go of the situation. Debt ballooning out of control, the deficit ballooning out as well. That is not what we need to do. So the question you ask, coming back to that, what can he do? Well, what he doesn't need to do is pour more good money after bad, pouring it into this abyss with SAA. And that, I think, is reflective of a mindset that doesn't quite grasp the seriousness of the situation.
Concerning.
Yeah.
And then let's just look at a piece of data, PPI, that is producer price inflation, which is important because it's indicative of what's happening with inflation. Now, that rose by 5.2% in September on a year-on-year basis. In the previous month, it was 4.2%. So it's quite a leap. It's a full percentage point. Your views on that and what it means for inflation going forward, especially with a weak rand?
Yeah. Look, there is a link between producer price index and the CPI, the consumer price index. It's not as strong as it used to be, but nevertheless, I mean, this is what economists refer to as inflation at the factory gate. So in other words, you're looking at inflation as it comes out of the manufacturing process. And it's concerning now that it has risen by quite so much. The suggestion is that if you kind of tie it into the CPI, there may be some CPI shocks a little bit further down the drag. On the plus side, of course, if we look at CPI in isolation, demand out there, certainly from consumers, has almost dried up entirely. There's virtually no demand at all. Any inflation that's coming through is caused by cost push rather than demand pull. And so I think this is just reflecting that. Coming back to your earlier point, if the rand continues to weaken, it means that in the manufacturing process, it means there will be more pressure on imported goods going in there, and again it gets into this vicious spiral.
Okay, well, we're going to leave it there. Thank you very much for your insights, as always. Well, that was Chris Gilmore. He's an independent analyst, not painting a pretty picture about what we have to look forward to in the South African economy. After a short break, Francis has more business news for you.